depending on where you're joining us on this webinar. Welcome to another one of the Chapman Group's webinars. This one is going to be focused on metric-based account segmentation and how you and your organization can optimize resources and other customer assets by segmenting those accounts and customers and executing based upon prescribed, what we'll call account treatment strategies that are developed through the segmentation process. A couple of quick administrative things up front. I am Denny Chapman Jr. I am sort of the moderator and Sherpa on these webinars. A copy of the slides and the presentation will be made available to everyone who's attended after the webinar is done in a few days beyond. So don't worry about that. That'll happen. On the right-hand side, there are some chat windows where you can either ask us some questions or send in any comments you might have. Please utilize that time and utilize our expertise and ask any questions or any comments that you might have, and we can address them towards the end, where we'll have about 10 or 15 minutes to do so. It'll probably be about a 40-minute webinar. And yeah, I think the stage is set pretty well. We have Dennis Chapman Sr., who's going to be presenting the webinar for us today. He has decades of strategic account sales management experience and expertise. Also a member of the board of directors for the Strategic Account Management Association, which, if you're not already a member of or participating in and interested in account segmentation, their annual conference is coming up in May. Could be a good thing for you to look into. But anyhow, I'd like to welcome Dennis and let you guys get to the good golden nuggets that are contained in the slides he's about to present.
Well, Denny, thank you very much. I appreciate the kind introduction. And, you know, this is a very interesting topic this morning. And today's topic, certainly around metric-based account segmentation, is probably one of the, in an area that we get probably some of the most questions we are asked in the area of account management, because of a lot of things we're going to talk about through the webinar today. And much like yourself, I'd like to say thank you for those who have tuned into us today, and kudos, because I really believe, as in this profession of certainly strategic account management, the challenge of to keep learning and updated on what we term best practices out there is quite challenging. And if you're taking time out of everyone's busy schedule, and we all know how busy we all are, that's kudos to you. Just again to reinforce what Denny said, that afterwards we'll be, you know, after about a 35-minute, 40-minute webinar here, we'll leave some time for Q&A, and then we'll also be making available, as Denny will wrap up, how you can all receive copies or access the webinar we covered today. So if we were in our local towns or villages or cities or wherever, and we picked up the Business Daily on Tuesday, March 25th, and we saw the headline in our company that said, "Big billing accounts demand it all for free," I think it might be a great way to summarize what we are seeing a lot of suppliers experiencing out there today, which is a lot of what they might call their top accounts are asking for an awful lot from their suppliers. And there's quite a bit of pushback sometimes if they are not in what we would call high-level relationship or partnership with those clients. There's quite a bit of pushback, quite a bit in the global economy today on trying to get things for the best price possible. I'm a little eccentric here by using for free, but I think if we kept dropping the price, ultimately it might be perceived as free. I found a cartoon a while back that I think sort of summarizes, I think, a little bit about what some of the attitudes are around from customers in some cases. How much if I peddle? And, you know, not that your customer is probably asking you these type of questions, but certainly they're asking you to be creative and say, you know, how do I get some of your very valuable solutions or products or services for a much better price? Another headline that, you know, maybe we need to put in our Business Daily once in a while is Supplier Fires largest account. The savings expected to exceed over $1 million. And, you know, not to take this too literal, I don't think what we're suggesting today is that we want to terminate necessarily relationships with some of our customers that may prove to be very costly, or maybe the return on the investment we're making isn't as good as it should be. But we certainly need to take a hard look at what the financial aspects of the relationship is, and to make sure that that it's working for both parties, not just for your customer, but also you as a supplier. And as we'll get into shortly, I think the real message here is that maybe we don't fire them, but we may need to look at maybe an alternative, what we would refer to as servicing model. So what are we going to talk about today? Today we're going to talk about, a little bit about why segment accounts. We're going to talk about those critical factors that make up and impact the segmentation model, sort of what we prescribe as an effective metric-based model. A simple measurement system that gives us very quantitative output so we can make better decisions. I'm going to talk a little bit about way clients are utilizing this output today, and to Denny's point around this whole thing on account treatment strategies and tactics. And then we're going to wrap up with some what we would recommendations, next steps for you that you may consider as you begin that journey of putting in the cadence or rigor of doing account segmentation every year. So the first question on the table is, why do we really want to segment accounts? Well, a few years ago, I wrote and published an article in CRM Magazine, and basically the article was called Clients, Customers, Buyers, Which Do You Have? And the essence of this was to say that we could take, based on some critical factors and information, we could probably take our account portfolio and break them into three types of relationships. One might be a client relationship, one might be a customer relationship, one might be a buyer relationship. And telling them apart, understanding the differences in this could really mean the difference between being profitable or operating at a loss, especially as it relates to a specific account. I will say one of the most significant movements I'm starting to see gain momentum out there is there's an awful lot of companies today that are trying to put together what I'll say a cost-based accounting at the account level, and basically trying to better understand, based on the cost of goods sold or produced, all the servicing associated costs and marketing costs. They're trying to look at that at an account level, and some of it's an allocation type model, and then look at what revenue they're appreciating from a customer or account, and they're trying to determine, when I bake all those factors together at an account level, is this account really a profitable account or a not so profitable account for us? Keep that in mind. That is an emerging practice. There are some companies starting to begin that journey now. I think within a couple of years, it's going to be very critical that we understand from a financial standpoint, because obviously financial metrics influence us all. So what makes up a client? What makes up a customer? What makes up a buyer? Well, really, a client is those accounts, and you probably know them right now in your portfolio, and they're the ones that are really a little more transparent and open with you as a supplier in the relationship. They appreciate the value that you bring to them. In some ways, they actually can quantify or understand the economic elements of that value. They offer you ongoing profitable partnering opportunities by keeping your pipeline filled. And probably not the most important, but certainly equally as important, is they're quite often willing to pay what you would call your market rates or your value-based pricing. And that's very critical. I'm going to go down to the bottom first, to the buyer, because really some of these really emerged quite a bit in the late 1990s and early 2000s with the advent of the traffic on the internet. What we saw during that time period was all the way from auctions, internet buying, unlike relationship or transactional buying through sales teams or account managers, there was this tremendous emergence of organizations that wanted to buy from suppliers in sort of what we would call a low-cost model. And they literally, in many cases, were treating everything they purchased as a commodity, and even some things that weren't commodities were being purchased as commodities. They actually almost were putting up a firewall in some cases between themselves and their suppliers and creating this us against them environment. We have good news, seen the pendulum shift a little bit away from that, but there's still quite a bit of relationships out there. We're not critical of any of these. We're just actually stating what they are and that they do exist. And as you'll see shortly, what do we do about that? The third segment that I want to speak to today is what we call customers. And this is tricky. These are those accounts that we might have in our portfolio that want everything we offer. Unlike the buyers, they're willing to, in some cases, give it up, some of these value adds. The customers want it all and even more, but they really want to pay the buyer price. They want to pay the lowest cost possible based on a commodity-type purchase. These are dangerous in our portfolio. And I say they're dangerous because they're the ones that really tack our resources. They challenge us. They cause us to have to react quite a bit. And it's very hard to make these a profitable entity for ourselves. So what is our recommendation here? Our recommendation is once we identify, as we get into shortly how to segment our accounts, is once we identify where our accounts fit in maybe one of these three type of tiers, that we take initiatives to either move our customers to become clients or our customers to be buyers. But ultimately, we would probably, ideally, end up with only one or two servicing models. And one servicing model might be a client servicing model. We'll speak more to that later. And the other could be a buyer servicing model. A little bit of that is based upon certainly what you're offering and your marketplace. But what we've learned is both can coexist in the same business. By the way, some suppliers have some services that I would say are value add, and some may be commodity. And the two type servicing models within their capabilities is a great solution we found to tackle that problem. There are three critical questions that we need to be aware of when we get into account segmentation. One is certainly the total cost of servicing and what is our payback. This ties back to what I was saying earlier about the whole trend or movement towards account-based costing, and to know exactly, even including cost of goods sold, what it costs us to service an account versus what revenue, and basically the net of those two factors, revenue and total cost of servicing, is what we might term our gross profit. That's probably a pre-EBITDA number, but it is at least a gross profit number. That's a critical factor as we do segmentation understand. The second piece that is very critical, a question for us to be thinking about is what I would call both a now look and a future look. A lot of organizations that we encounter have done segmentation predominantly based on historical economic views. What we would like to recommend, as you'll see shortly, is that we want to take a view of two things, the economics and relationships as they are or have been, but we also want to do the segmentation process with more of a futuristic view. We want to look at the future as it relates to profitability or economics as well as relationship. So we end up understanding who will be our most profitable accounts and strategic relationships, and even who might be our least profitable and least strategic relationship. And then finally, when we get into this is, so what are we going to do about it? And we would like to term that our treatment strategy. And I'm going to give you some ideas around 4 basic treatment strategies today, but definitely I mentioned you might have 2 servicing models, and even within that servicing model, we would have a treatment strategy. So most things all start with some form of a definition. So let me give you what we would term the components of a good definition of account segmentation. It's certainly a process that we classify accounts, and there's 2 predominant axes we look at. One is the financial value contribution, and the other is the relationship status. Account segmentation is certainly a process. as you'll see shortly, and it should have some form of methodology, again, that I will demonstrate to you today. It should have critical methodology in how we ask the right questions and understand the relationship, and it should align the results and the outcome, should align and point to us to some form of a treatment strategy. And the final definition component is that it really should show us at some point that when we do a real effective job of segmentation, that we're pretty much ensuring that the total value exceeds our cost of goods sold, including servicing costs. So when we start to use the segmentation model, we do end up understanding what are those accounts in our portfolio that give us the proper payback. A question we do get quite a bit is, how often do you do segmentation? We recommend an in-depth look at segmentation annually, but we also recommend that it's a good idea to maybe take a quick snapshot review of it in 6-month intervals, because things do happen. Companies merge, get sold, they change, contacts or relationships in our customer change. So certainly a snapshot every 6 months, but a much more in-depth review of our account portfolio is critical every year. What are our goals here? Our goals, as it relates to segmentation, is to really have a successful process that helps us identify those, what we might call our top accounts for revenue retention. What are those most loyal partnership accounts? And what are those accounts that can be targeted for our greatest potential opportunity? Again, we don't want to just look at the rearview mirror. We want to look to the future here, because it comes upon us rather quick. So we want to use segmentation as a way to help us predict the future, where we should apply our resources. And there is this other intrinsic question we have to consider when we do this. These are the accounts with the greatest strategic value. And I'll talk more about that, but when we start talking about strategic value, it could be an account's presence in a marketplace, their brand presence, and it could be just their overall value of having them as an account. Now, just as a heads up, I'm not suggesting that the segmentation process is purely 100% measurement metrics. I do believe that, as you'll see later, that there is some, obviously, intuition or experience applied to the segmentation practice, but what we are recommending that is predominantly driven by some relatively quantitative measurements and metrics. A little bit more about that, which was my segue to say that we would like to think of account segmentation now as a much more analytical process. And as I mentioned, there is an x-axis that we'll be talking about, financial importance, as well as a y-axis, which is relationship. Accounts should then, based on the factors that we identify, sort of get ranked in financial importance and depth of relationship, and again, as you'll see, end up in 4 different quadrants that will enable us to apply a treatment strategy. Now, just a little bit of terminology, and by the way, this is up to each organization, their culture, their history. Whatever you call the accounts, we're okay with that. That's your decision. But clarity around definition is real important for your organization. So if you do use terms like strategic accounts, key accounts, large accounts, major accounts, it's very important that you add clarity so that your organization understands what we're referring to here, and that they align to what you do in your segmentation model. So we're not prescribing you have to use a set nomenclature, but whatever you do, it's very important that you communicate it effectively throughout your organization. So what's the process look like? The process to do segmentation is what I would call a 5-step process. The first is you probably should put a team together and define the goals and objectives of this exercise, and understanding, what accounts we're going to take a look at, what element or components of our portfolio. Is it all of our accounts? Is it the top 100? Is it the top 250? Is it the top 50? So we need to understand that. Second, we would prescribe that you adopt some form of a segmentation model. I will show you a version of that we use with our clients today. And but you definitely I would recommend, whenever possible, is not try to reinvent the wheel. I would try to capitalize on some existing thought leadership or expertise out there so that you sort of get a head start on this thing and not have to reinvent things. The third is you want to run once you get your model built up, and you want to validate it and start running a small pilot number of accounts through it. You may run an account, put the data inputs of a client that's pretty self-obvious that it is a client account. You might want to take another one that's a buyer account and see how those accounts work through the model and make sure there's no strange inputs or deviations relevant to that. So we would call that to validate the model a little bit. Once you're comfortable that all the components of the model are proper, it's validated, now it's time to actually start plugging in the information that we know about our accounts and actually allow the tool, what we call the segmenter, do the segmentation. And literally, it's populating fields of information relevant to financial and relationship that I'll give you some examples of again shortly, so that you start to get some outputs and you'll start to see the picture come together of what your portfolio of accounts looks like. And then finally, which is very, very critical, and by the way, this is probably where some organizations unfortunately maybe drop the ball, is they do a very good job or an adequate job of segmenting their accounts, but they really don't define what the treatment strategy should be so they can act on that. So the very final leg of the journey here, you might call it the last mile, is to really have some very determined treatment strategies so when your accounts plot out in a grid, you know what to do with them. A lot of information on the slide you're looking at today. I'm just going to summarize it. You're looking at an Excel model and basically what we call the segmenter. And the upper left, you'll see that in the blue areas, you want some filtering or sorting capabilities so you can look at the accounts in the model by different views. You might want to look at it ranked by a financial view or relationship view. You may want to look at it for top hits of critical factors, but you definitely want to have some ways you can, once the data is inputted, that you can sort and filter that. You also then want to make sure that the model is really aligned to your organization and properly plots those accounts, as I mentioned. And then that's where you do the validation effort. But this is a little bit of a glance of what the model looks like. There's data fields. Ultimately, your data fields on the bottom of the screen are drop-downs. So when you complete a segmentation model, you have choices. So to get a little deeper into what that looks like, it all starts with one tool, which we call Segmenter. And there's two critical elements in segmentation, as I mentioned, financial importance and relationship importance. And you want to assess both. We prescribe that we weight each equally, 50-50, and that's important. There are some organizations that can make business cases that one might be a little more important than the other, but it's not a bad idea to start with the 50-50 equation. On the left side, the financial importance, again, we want to do sort of a now look, which would be our current financials, certainly recent financials, as it relates to this account. I'll give you some examples of those again shortly. But also, we want to take and look at the future. Now, I broke it out 40-60. You may break it out 30-70 and say, look, the future is much more important in our segmentation model, in our view for the future, and you can weight these a little differently. So I've sort of just introduced another term, which is this whole thing around factoring and weighting. So answers have certain kind of factors and weights so that ultimately they roll up to equal whatever value the financial importance has in both of the views. We do a very similar approach in the relationship assessment. We want to basically take a good look at the relationship and say, what is the current status today, and what's the alignment and fit between our organizations? And that's critical. Those two components, again, make up the critical pillars relevant to the relationship assessment. And then when you combine that, you end up with what you might call an account rating in the segmenter. Now, just as at a top line, The measurement system is, again, if you look through the table there, these are just for demonstration purposes. This is what maybe the output looks like, where you got an account which says account 1 that has a financial rating, a relationship rating, and then the quadrant, which we'll talk about, is really what we talk about treatment strategy, and number of critical hits are factors that we might isolate that are very critical, unique to our business. Again, the fill-ins in the model, and I'll make this a little larger shortly for you, are usually just drop-downs that help populate each one of those categories we see above, or subcategories. Example, in the relationship side of the equation, in relationships we have two components there. These are some of the factors that you might want to take a hard look at. And these are very critical factors, whether it's number of years, important to solutions, and maintain the relationship with us. Are they willing to? Do we have high, wide, deep relationships? And even to the point where a lot of organizations today, if you see overall loyalty satisfaction rating, there are organizations today that are integrating in their voice of the customer into the segmentation model. And I think that's a very, very important point, because that really gives us a view directly from the customer. Do they really want to have a relationship with us? What do they perceive this relationship to be? And then to the right side are what I would say in the category of strategic alignment are obviously some choices that we would want to weight out based on some choices here about visibility to the organization. Probably one of the most critical is, are they willing to partner with us? Are they willing to be collaborative? Are they willing to be transparent? You know, these are factors that we know that for a client account, for example, we have to sort of have a yes, 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 or we probably will not be able to have what we might term a client relationship. Again, we're not suggesting we get rid of any accounts. We just want to, again, use this information to help guide us in which accounts fit best to our existing servicing strategies. In the financial area, and I'm giving you literally a very quick snapshot of some of the category, but subcategories. In current financials, we might look at total account revenue, number of products, could be number of leading products that they bought from us, and their financial stability. You know, are they growing? Are they going backwards? That could play a role. It could even be, you know, what the revenue trend with us is. So there could be these categories around current financials. But future, I want to take a hard look at, you know, are they a growth company? Are they going to be a company that affords us opportunities as they grow to grow with them? Are they going to have a good impact on our pipeline value? Are they going to be willing to consider and use what we might call our leading products or services? And then the other factor in the future is, are we growing what we would call our wallet share? Is our wallet share a good representation? Because good wallet share means if we basically, for the monies they're spending on like services, we're getting more than our fair share. That's a great indicator for the future opportunity if we can sustain that wallet share, because as that organization grows, our account organization, we should grow in step with them. So there's some critical financial factors we want to consider. Ultimately, this is what it looks like. I mean, once you populate a segmentation model, you should end up with, even though it's a little hard to read, but this is, again, just account numbers on there, you'll end up with 4 quadrants. We use terms like invest, upper left, upper right leverage, bottom left monitor, bottom right capitalize. And you've got the financial metric and the relationship metric as your axes. But once you have it plotted, okay, this is then what you really, where sort of the rubber hits the road for you as an operating organization. Because here's where I can look at, for example, accounts that have high financial impact on that left axis, and on the bottom axis, they have high relationships. Okay, so high financial, high relationships that we have, they would end up in that upper right leverage, and that would lead us to a particular treatment strategy that would be much different than accounts on the bottom left that had low financial value to us and we have little if any relationships there, they may be more monitored. Again, that word in itself indicates we don't want to necessarily get rid of the revenue, but we probably want to really be very sensitive to the amount of investment as well as resources we apply there. And certainly when we've got in the upper left high financial opportunity but low relationships, we may want to invest more. And that will in itself tell us there's some great opportunities here because maybe we can move that account from the upper left to the upper right, and that becomes a long-term win for us because we can capitalize, not only gain more value from that account, but we insulate it or protect it with better relationships because our relationships are better. It's not often we see the bottom right, which is where we have great relationships and low financial value, but it could happen. It could be a customer that just doesn't have the magnitude or capabilities to give us the revenue or that we need or expect, so they end up in the bottom right, but we are what we term high, wide, and deep in the account. That's a good thing. We're getting our fair share of finances. They just don't have a lot of revenue to provide us. We don't, again, want to give those accounts away, but we'll manage those. We'll capitalize on what we can get, and over time, that'll be our position. Now, what we recommend is once you've done the segmentation model and work with an organization like ourselves or whatever and understand what the treatment strategy is, that you start to fill in things like in each quadrant what the goal should be, what our strategies could be, and what are those critical activities we're going to do. And this is where this links extremely well to strategic account management, because literally, if I'm a strategic account team, I'll see where my account falls in which quadrant, and I should be getting some well thought out strategies and activities to help guide me in my account planning activities and exercises around my goals, strategies, and activities. So again, the account segmentation model is meant to help guide the recipients of the output, which are really the strategic account leaders or managers and their teams, in what probably a prescribed strategy or treatment strategy might be. And by the way, the treatment strategy is not meant to keep an account in the monitor or keep an account in invest or capitalize. It's meant to apply the right resources accordingly. It would be obviously great to have all accounts end up in the upper right leverage. In reality, it's not going to happen. So I just want to make sure that the plotting of my accounts enables me to do that. Now, just as a point of reference here, this is probably a body of work that needs to be done by the corporation or by the sales leadership or marketing leadership before it gets to the field. This kind of treatment strategy and recommendation, certainly it would be a good idea to have a task force or a team develop that because you want to sort of institutionalize these in the organization. This is something that would be very valuable to roll out in what we might call an account management playbook. This is a great piece of content when you would have an account management operation manual. We call it a playbook. These treatment strategies are excellent sections within a playbook. Okay, so once you've done the exercise and you've followed this whole process, and just to summarize some of the critical things, you define, you obviously want to have a team, you define what your model is, you want to make sure that you agree on the language and definitions around your accounts, you want to make sure that you adopt some type of, we happen to like Excel as a model. It's meant for doing analytics. It's a great tool, but you need, very critical here, you need some embedded methodology to do segmentation. We recommend to use what we call a category, subcategory with values approach. That you saw that tier down approach that we talked about. You should want to do a little bit of body of work around customizing them, making them fit for your world, your business, your company. You then want to, the next step in the process is to make sure you're in agreement on the treatment strategies as they relate to the 4 quadrants. By the way, they were the names we give the quadrants. You may want to use some existing nomenclature you have in your organization or not. It's up to you. But what's critical is you drill down a little deeper and actually have some treatment strategies with names and actions. Once you've got that, you actually just keep the process going. Plot your accounts. Put them in there. Get it completed. Solicit the information from the organization and get all the accounts that you want to segment plotted, and then take appropriate actions in rolling that information out to the appropriate SAM and or their SAM team. Now, the final next step that we recommend is this really should be a critical component when you get into your whole account planning cycle. For example, when we work with organizations and do what we call metric-based account plans, we allocate space within the account plan itself to have the quadrant identified of where the account ended up being segmented and what the treatment strategy is as an influence to the team when they're building their account plan. So bring it into action. I think analytics for the sake of analytics is not that strong, but analytics as a component to help influence and drive action planning in our strategic account management program is critical. So again, it's a strong suggestion that this information from your segmentation process ends up in your account planning exercise as well. And it is something to be reviewed probably at least on a 6-month basis and certainly annually. So in summary, my key points are basically segmentation is a process. It needs some embedded methodology. It is a little more scientific than it used to be. I would argue years ago it was a little more qualitative, intuitive. But moving forward, as we know in the world we live in today, everything is analytics. And that's probably the way to make sure we get it right and give us better data and facts to live by, facts and insights. So I know we've gotten a few questions, and I'm going to turn it back over to Denny. And we're staying pretty true to time right now. So let's see what we got here.
Thank you. Good presentation. I got a couple questions from people who, joined late, and they want to know about the slides. And slides will be given out, and you'll get a link and ability to go back and review the webinar, et cetera. So don't worry about that. That'll happen. So back into some other questions we got from people on the webinar. There's 2 that stand out and I think would be valuable for these people to listen to or get an answer for. The first one has to do with who you involve in the segmentation process. So what kind of tips or expertise or advice do you have on who organizations should include in their segmentation model development and process?
That's a great question. I would suggest, and this is from experience, it's good to have certainly the representation of the sales leadership or account management leadership team. By the way, a marketing representative is good because they quite often have some good insights into what some of the data and subcategories are critical. If you've got somebody that could fill a role that we would call sales operations or operations, they're a welcome component as well. And definitely you need some type of senior leader that we would call executive sponsor of the segmentation process. And within all those, somebody who we might call an owner. It is probably also a good idea, we've seen this work very well, when you include not all, but maybe some of what you would call your go-to account managers or SAMs, a couple, 1 or 2 of them, to give you some insights to as you build your model. So that's sort of what the team looks like when you do the construct of this whole what we call segmenter.
Okay, thank you. And there's one other question. So is it possible that some of our best accounts are not really our best accounts after this exercise? So I think because you said you recommend that people do segmentation annually. So if you could speak to the idea and possibility that a strategic account might not actually be a strategic account when it goes through the segmentation process at some point.
Yeah, again, that's a good question. Unfortunately, we've seen a lot of of our clients first time we meet them and we get into segmentation modeling is that they've used maybe purely a financial metric to this. And it's an important metric. I'm not discounting that. But in the first iteration, I'll say the first year you do it, I would say that it's going to be a little shocking with some accounts. When you go through the exercise, what you might have been convinced as an organization are important accounts, they end up, some of these accounts fall into the middle of the pack or even towards the bottom of the pack based on some criteria. And the other thing happens as well where some accounts that you weren't thinking as holistic around end up being a little higher ranking, or in your top account, for example, future opportunity drives them to be a little higher. I mentioned that in the first year because this is sometimes a new process for organizations. What we recommend is certainly take that information, act on it, but maybe don't wait a whole year, but learn what you can when you go out and apply the treatment strategy just to validate that you didn't miss any critical information. Year two, when you do it, you really start to get a little more normalized picture. But, you know, the answer is it is very possible that we've been servicing some customers, over-servicing with assets and resources versus when I spoke to the return on investment. And we may need to take a hard look at that the upside or the profitability is not there that warrants that. So I'm not saying they're still not good, valuable customers, but they may be just different kinds of accounts for us. And it's quite possible we may have a little different view around certain segments of our portfolio. And that does happen, yes.
Thank you. Let me do one more quick check, see if anything came in the last couple minutes or last couple seconds. Nope. All right. So, folks, that is the conclusion of the webinar. Thank you for attending and joining and listening, and I hope you got something valuable out of it. In the lower right-hand corner of the screen, I did want to highlight that my contact information is down there. You can see the phone number and extension, also my email address. If you have any questions, needs, wants, questions, whatever, send them my way. Give me a call or an email address. You can find me there, and I will help you out along the way. So thank you again for joining, and I hope you have a wonderful Tuesday.
Have a great day. Thanks.
Bye-bye.